Well, Canadian housing sales fell more than 3% in October compared with the previous month. This after housing sales were brisk through the summer. And from a bigger picture point of view, Canada's housing market has been on a near constant upward trajectory since 1997, hitting all-time highs on a regular basis. But while bearish commentary from economists who work for big banks in Canada has been scarce, other institutions, many of them outside of this country, have been sounding a warning call for some time now. Goldman Sachs, the IMF, The Economist, and most recently the Financial Times have pointed to an overcooked market ripe for correction. Our next guest has been bearish on the Canadian housing market since 2011. He believes Canada is in for a prolonged and painful correction that could see prices fall as much as 25%. Joining us now is David Madani, Canada economist with Capital Economics. Good to have you back with us, David.
Good to be here.
Thanks for coming in. So, is it getting lonely, this call? You've had this call since 2011. It hasn't happened yet.
2011, but I don't think we're outliers. Like as you mentioned at the beginning of the show, more and more institutions outside of Canada are raising some red flags in terms of the Canadian housing market. They see what we see, which is overvaluation, overbuilding, and excessive household debt. So I think the outsiders in this particular case are closer to the mark.
Do you think they know what they're talking about?
Absolutely.
I mean, a lot of American hedge funds went short in the spring on Canadian banks, and they got toasted on it. The banks are all at all-time highs.
No, I think they are close to the mark because the symptoms we see in Canada, we've seen in other developed countries that have gone through fairly pronounced housing boom bust. So I don't think Canada's any different. Now, I appreciate the fact that trying to get the exact timing of these sorts of things is difficult, but in the U.S., the U.S. housing bubble took a long time to pop. Concerns were raised as early as 2002, 2003. Robert Shiller was probably, some would argue, was far too early in calling the housing market. So, I mean, this is the nature of housing markets, and but I'm still very much concerned in terms of valuations, for sure.
When you say painful and prolonged, I mean, 25% is the figure.
Yeah.
We had that in the intro, but
yeah.
Prolonged, what do you mean by prolonged?
Well, it's something I think will play out over a few years, and it will have much, very broad implications for the domestic economy. So I think, Canada's past performance really isn't a good indicator of future performance in this case, because I think housing will be a fairly big drag on the economy over the next few years.
But as you know better than I, this is all about local markets, really, rather than a national view. And if you compare, say, a Toronto to a New York, people have been saying this kind of thing about the New York market for years. And prices have held up and have kept going up.
To be honest, I'm not sure how sort of valuable it is in comparing housing markets in Canada to New York. I mean,
Toronto.
Yeah, no, when I look at Canadian house prices, I look at Canadian incomes and Canadian rent prices to gauge valuations or how valued housing might be. So on that basis, I mean, Canada really hasn't been in this situation before where valuations have become so stretched. And affordability is a major problem in Canada. It's a major problem in Vancouver. It's a major problem here in Toronto and certain other major cities in Canada. And that's one of the reasons, apart from the speculation in the condominium market, that I'm very concerned about the housing market.
Is it valuations or is it the ability to service the monthly debt payments?
It's really about affordability. The banks here, of course, are popular for saying, oh, interest rates are so low. But one thing I found quite striking in the recent National Household Survey is actually that affordability is almost as bad as it was back in 1996. So the National Household Survey showed that actually over a quarter of homeowner households are actually spending more than 30% of their income on shelter costs, which actually is close to a record high that we set back in 1996 when interest rates were actually much, much higher than they are today. So I think even modest or moderate increases in mortgage rates over the next few years could have a serious impact on housing affordability.
But do you actually think that is going to happen? Because the most recent statement from the Bank of Canada turned more dovish.
I think we over the next few years, I think we'll see mortgage rates go up because bond yields will go up. The Bank of Canada will try to lean against that. But I think it's possible that the Bank of Canada could get in sort of this reverse conundrum effect that Greenspan faced in the US, where the Bank of Canada tries to signal that short-term rates are going to remain low for quite some time, but bond yields go up, and of course mortgage rates tied to that go up as well. So that could be the twist here in the Canadian sense.
So what are the potential consequences if you're right? For instance, the construction industry. How many Canadians are employed by the construction industry?
Well, it's huge. I mean, if you look at construction employment's percentage of total, it's at a historical high. Now, to be fair, part of that is because of the strength in non-residential activity. It's not all because of housing. But a lot of activity in the construction sector is tied to the condominium market, where my sense is now that prospective investors are backing away in large numbers.
Speculative investors?
Speculative investors. I mean, we have actually, one thing we do have in Canada is new home sales for the GTA. Fortunately, we don't have new home sales for the rest of the country. But what that actually shows is new high-rise condo sales have actually declined by about 50% over the last 2 years.
What about
that doesn't sound like a soft landing to
What
me.
about foreign investors who want a stable place to put their money? I mean, that has been a phenomenon in
yeah, it has
recent
been,
years.
but no one's been able to quantify that. And for as long as I can remember, foreign investors have always been fairly active in cities like Vancouver. I have family in Vancouver, so I know they've always been active there. But whether or not it's contributed more to this housing cycle, it's unclear to me. We just don't have data to quantify. I know that they're there, but the other thing too, it's all fine and well to talk about foreign investors in a rising market, but what happens when the market turns, right? If you don't live here, you're really going to continue to hold these condominiums scattered across the country. So I'm not so sure. Some will because they like the stability of Canada, but I'm not sure if that's a solid argument.
Just 10 seconds left. You don't own, you rent. Is that correct?
Oh, is that really important?
I mean, I want to know if you eat your own cooking.
I will acknowledge that I'm actually renting.
Okay. Okay. Strong signal there, I guess.
Perhaps.
Anyway, good to have you back, David.
Good to be here. Thanks.
Thank you. David Madani of Capital Economics. If you missed any of today's program, watch it online at bnn.ca or on the repeat tonight, 8 p.m. Eastern, 5 p.m. Pacific. You're watching Headline on BNN.